Alrighty guys, welcome back to the channel. Tonight is Monday the 27th of February, and we got a good one lined up here tonight, folks. In my humble opinion, of course. So the topic of discussion tonight is perfecting your entries and exits. So we got a 15-minute chart here of the S&Ps, and here's today's action. So today's action was brought to you by a pretty good gap up at the open, a pretty impressive push for the first 45-50 minutes of trade, and then around 10:25 a.m. Eastern, everything just pretty much fizzled out, and that was ultimately all she wrote for today. So, because I've been there and done that before, I'm willing to bet that a few of you woke up excited to trade this morning. You've been waiting all weekend, you're jonesing for the action. So when the market gaps up, it's a little bit easy to chase that move. You're feeling the FOMO, you're feeling the beautiful emotions involved with being a human being, pretty much. So if you chase this move this morning, you probably spent all afternoon a little bit pissed off that things fizzled out. And I don't want that for you guys. I don't want you spending your afternoons pissed off. I want you spending your afternoons profitable and walking your dog. So as far as perfecting your entries and exits, we got a couple of tools of the trade and a couple of key concepts. So we'll tie them all together here. The first thing you guys want on your charts is the 21 EMA. That's your 21 period exponential moving average. The second thing you want on your charts is a pair of Keltner channels. So I'll show you the settings for the Keltner channels, and then of course on my end, my structure and momentum tool is going to be the big 3 indicator. And then as far as a few key concepts, we've got momentum exhaustion, ATR, average true range, and RTM, reversion to the mean. So we'll jump in here, guys. The first thing you want on your charts, 21 period EMA. So that, of course, is pretty straightforward on your platform of choice. Go find your exponential moving average, and the only thing we're looking for here is a length of 21. Now, as far as the style, as far as the color, I won't judge you. You can do that as you please. I like my white dotted 21 EMA personally. So, get yourself a 21 EMA, and then as far as the Keltner channels here, here's what we're looking for as far as the settings. So, find the Keltner channels on your platform, and we're looking for displace of 0, factor of 2, length of 21, and the biggie, average type exponential. Alright, displace 0, factor 2, length 21, average type exponential. So now what that is going to do is plot these Keltner channels on your charts, and these Keltner channels are going to measure 2 average true range moves above and below your 21 EMA. So ATR, average true range, that's just the average move that a stock will make up or down any given day. A basic concept, but I think a really important one. Alright, so 21 period exponential moving average, and a set of Keltner channels measuring 2 average true range moves, both above and below that 21 EMA. So going back to the concepts here, one of the biggest, I think, concepts you want to really have a good grasp of in trading is RTM, reversion to the mean. So the 21 period EMA, that serves as our mean, right? That's officially, or you kind of look at it like home base. Right? Your 21 EMA is home base. And all the concept of reversion to the mean is, or all that it means rather, is that every market and every stock always comes back to that 21 EMA. We always revert back to that moving average. Whether we're in a downtrend, whether we're in an uptrend, we're always at some point going to come on home to the good old 21. So, pretty basic concept, but here's where you tie it all together. Where there begins to be a growing probability of that reversion to the mean is when we're trading more than 2 average true range moves away from the moving average. So in plain English, anytime we're trading above or below that Keltner channel, there's now a growing probability that eventually we're going to pull back to it. So for me, that's a golden rule in my trading. If we're above +2, if we're below -2, we're probably gearing up for that reversion to the mean sometime soon. So for some context here today, guys, we gap up at the open. However, your 30-minute chart pushes directly through +2. So you know what that means for the 30-minute chart. The 15-minute chart opens up well above +2 and continues to push. Of course, your 5-minute chart opens up well above that +2 channel, just continues to push further and further away. And we'll look at a 3-minute chart here, and of course the 3-minute chart opens up a couple of country miles away from that 21 and continues to push. So as bullish as things look at the open, as strong as things look at the open today, what you would have wanted to have taken into consideration was that from a 3-minute chart all the way up to a 30-minute chart at the open, and especially 15, 20, 30, 45 minutes after the open, your 30-minute chart all the way down to your 3-minute chart, we're trading above +2. What that means is your 30-minute chart down to your 3-minute chart, as good as they look, as bullish as things might feel, they're already fighting this growing probability. We got to come back to that 21 EMA. So now the next concept kind of ties all that together, and it's the concept of momentum exhaustion. Look at that as a gas tank for the bulls or the bears. The bulls will typically pump the market. They'll push, they'll push, they'll push, they'll push all the way until they run out of gas. That moment in time when they begin to run out of gas is typically when we're going to gear up for that reversion to the mean. Especially, guys, if we start getting signs of things running out of gas, if we start getting signs of exhaustion up here at +2. So peep this. And we'll anchor to a 15-minute chart because lately I'm kind of digging a 15-minute chart. As soon as we gap up this morning, I fight that temptation to get long because I know there's a pretty good chance we're going to pull back. And, if we just keep pushing all day long and we don't get a single reversion to the mean, then it is what it is. But the goal, of course, is to always fight for a good entry. So this morning, I'm fighting that FOMO. I'm not going to chase it. I'm not going to break my rules. Even if that means I miss all the action today, I'm not going to do it. I'm going to fight for a better entry. So anchoring to a 15-minute chart, check this out. Right around, 3-minute chart, there we go. So check this out. Right around 10:30-ish this morning, we start getting our first signs of exhaustion here on the 3-minute chart. Exhaustion means the indicator goes from bullish to neutral. We have a buy signal, and all of a sudden we no longer have a buy signal. To be clear, it doesn't mean, oh my god, the 3-minute chart is bearish all of a sudden. What that means is the bulls are running out of gas. They pushed it well above +2, and now as we're chilling out up here at +2, our indicator went neutral. That's the moment in time. It is a really good probability we're probably going to start a pullback to that 21 EMA. And now what happened was this morning, your 3-minute chart pulled back to the 21 and failed to hold. So it's kind of like a process of elimination. If the 3-minute 21 EMA can't hold, well, we're probably heading down to the 5-minute chart. And you guys can see right around the same time here this morning, the 5-minute chart went from bullish to neutral. Now your 5-minute chart ultimately failed to hold that 21 EMA, but more importantly, we never went bullish again. The indicator never told you to buy that dip and reload at your 21 EMA. The expectation should be, if we're going to get long, we're looking for things to behave like an uptrend. An uptrend should behave like this. We push, we pull back. The whole time the indicator continues to print that buy signal, we consolidate, and while still printing that buy signal, we turn the corner. Now, is it a big deal to go neutral on the pullback? Not necessarily, but point being, your 5-minute chart never went bullish again early this morning. So that opened up the door for a little bit more of a dip down to the 15-minute 21 EMA. And as soon as we got there, indicator went from bullish to neutral. And that was all she wrote. Right, so all those concepts kind of got tied together this morning. We found ourselves pretty strong at the open, but from a 3-minute chart all the way up to a 30-minute chart, we're a little bit overbought. Everything's kind of punching through +2, so now we know there's a growing probability. Sometime soon, we're probably going to revert back to that 21 EMA. We're probably going to see that reversion to the mean. And the first signs of that potential reversion to the mean are when you get signs of exhaustion from the ground up. When your 3-minute chart, as it's overbought, goes from bullish to neutral, and then as your 5-minute chart, as it's overbought, goes from bullish to neutral, those are signs of exhaustion. And if all of that is taking place when we're still well above a 15-minute 21 or well above a 30-minute 21, usually a pretty good indication we're coming on down. And that is what you saw today, guys. The real kicker, of course, is things never really turn bullish again. Like I mentioned, I'm anchoring to a 15-minute chart a lot lately, so pretty obvious this morning I'm not going to chase this. We're overbought, we're trading through +2. I got to wait for a pullback to my 15-minute 21. The heads up that I'm probably going to get that pullback to the 15-minute 21 are when my 5-minute and my 3-minute charts go from bullish to neutral. Right? The signs of exhaustion on those lower time frames results in that pullback to the 21 EMA on the slightly bigger time frame. So I got the pullback I was looking for, but I never got the confirmation to load the boat and look for a turn higher, as a 15-minute chart went neutral and never went bullish again. So I know I threw a lot at you guys here in a shorter video, and we'll talk more about this together in the future, but go back and rewatch this a few times and really hone in on the important concepts here. Momentum exhaustion, average true range, and reversion to the mean. And then tie it all together with a couple of good momentum and structure tools. Of course, I'm a bit biased, but I like the big three signals. But take whatever tool you prefer, and then tie these concepts together. Right. Next time the market opens and the 3-minute chart all the way up to a 30-minute chart are overbought, wait for your back test. Same thing applies, guys, when we gap down. We gap down, the S&Ps are down 1.5–2%, but your 3-minute chart down to the 30-minute chart are all trading well under -2. Try to avoid the temptation to short it, and instead look to short it after that reversion to the mean. Your clues as to that reversion to the mean potentially unfolding are when you get signs of exhaustion from the bears. Your 1-minute chart will go from bearish to neutral. Your 3-minute chart will go from bearish to neutral. The 5-minute goes from bearish to neutral. You're playing the ebbs and flows with that top down, but also that from the ground up kind of thinking. So guys, again, I threw a lot at you in tonight's video. If you have any questions, please drop them down below. I'll be more than happy to help out. But I figured, since I've been there, done that, I've waited all weekend for the market to open, watched the market gap up, bought some calls out of excitement, and then sat through the flush all afternoon. It's no fun. So as always, I appreciate you watching. If you haven't already, do me a huge favor, hit the like and subscribe button. And yeah, leave me a comment down below if you got any questions, if you found it helpful, and I will talk to you guys in the next video. Adios.